Welcome to FunFinance with Timetoheal, your go-to source for all things finance and investing. If you're new here, don't forget to hit that subscribe button and click the bell icon to stay updated with our latest videos. Today, we're diving into one of the most effective ways to build wealth over time, the Systematic Investment Plan, or SIP. Whether you're a seasoned investor or just starting out, understanding the best SIP strategy can help you achieve your financial goals. So, what exactly is a SIP? A systematic investment plan allows you to invest a fixed amount of money at regular intervals in mutual funds. This disciplined approach helps you take advantage of market fluctuations and build a substantial corpus over time. Let's talk about the benefits of SIPs. First, they promote disciplined investing. By investing regularly, you avoid the temptation to time the market. Second, SIPs benefit from Rupee cost averaging, which means you buy more units when prices are low and fewer units when prices are high. This helps in averaging out the cost of your investments. Lastly, SIPs offer the power of compounding, where your returns generate more returns over time. Now, let's get into the best SIP strategy. Here are some key points to consider. Start early. The earlier you start, the more time your investments have to grow. Even small amounts can grow significantly over a long period. Choose the right fund. Select a mutual fund that aligns with your financial goals and risk tolerance. Look for funds with a consistent track record and good performance. Regularly review your SIP. Periodically review your SIP investments to ensure they are on track with your goals. Adjust your investment amount or switch funds if necessary. Increase your SIP amount. As your income grows, consider increasing your SIP amount. This can significantly boost your investment corpus over time. Stay invested for the long term. SIPs are most effective when you stay invested for the long term. Avoid the urge to withdraw your investments during market downturns. Let's look at an example. Suppose you start a SIP of 5,000 Indian rupees per month at an average annual return of 12%. After 20 years, your investment would grow to approximately 50 Indian rupees lakhs, thanks to the power of compounding and Rupee cost averaging. Here are some common mistakes to avoid with SIPs. Stopping SIPs during market downturns. Market volatility is normal. Stopping your SIPs during downturns can hinder your long-term growth. Not reviewing your portfolio. Regularly review your investments to ensure they align with your goals and make adjustments as needed. Investing without a goal. Always invest with a clear financial goal in mind. This helps you stay focused and disciplined. In conclusion, SIPs are a powerful tool for building wealth over time. By starting early, choosing the right funds, and staying disciplined, you can achieve your financial goals. Remember, the key to successful investing is patience and consistency. If you found this video helpful, please give it a thumbs up and share it with your friends. Don't forget to subscribe to FunFinance with Timetoheal for more tips on finance and investing. Hit the bell icon so you never miss an update. Thanks for watching, and happy investing!